Hey guys, what's up? Welcome to today's financial focus. In today's video, I have an interesting topic, which is something about options that I think anyone who's trading options ought to be aware of, and that's how someone opening up a spread actually opens themselves up to a loss that is greater than the max loss that is depicted in Robinhood when we open up the spread. So let's say, for instance, I were to open up a put credit spread. How I would do that is I would sell a put contract like this one right here with the 120 strike, and then I would buy a put contract right beneath it with a strike price that's less than the short put. And we can see right here that would open up a put credit spread. And then right down here, we see that the max loss is $280, which is what Robinhood is telling us. But actually, the max loss is far greater than that. And in this video, I'm going to explain how someone could actually end up incurring this loss, which has happened to options traders in the past, and it's something that we all have to be aware of. So as we can see right here in the instruction manual, I guess, for Robinhood's options trading, we see right here they talk about assignment, and there are two key points here that I wanted to point out. Right here we see they talk about what happens if we're assigned on the short leg of our put spread. That's the put that we sold. And they say right here that if we're assigned on our short leg of the spread, we have the obligation to buy shares of the underlying security at the strike price. So basically what this is saying is if the share price of the underlying on expiration date, March 18th in this case, is below the strike price of the put option that we're selling, which is $120, then we would be obligated to buy 100 shares of Alibaba at $120 per share. So that would be a $12,000 Alibaba position, right? And then right here, they say that if our long leg of the put spread is out of the money, then this is what we would end up having to do. If our long leg of the spread is out of the money, we would sell that long leg of our spread, which is the put contract that we bought. And then we would separately sell the shares that we were assigned in order to cover our assignment. And so what does this mean? So basically what this is saying is, let's say the share price on expiration date expired at $119. That would mean that our short put is in the money, but our long put is out of the money. And so that would mean that our long put expires worthless. Typically with a put credit spread in this case, we buy the long put while simultaneously shorting the short put in order to cover our loss in the event that the share price drops below the strike price of our short put. But in this particular case, we don't actually require the long put in order to cover our position, because the share price did not drop below the strike price of our long put. It only dropped below the strike price of our short put. And so if we're forced to buy 100 shares of Alibaba at $120 per share, that gives us a $12,000 position. And if the share price is trading at $119 per share, that means that our $12,000 Alibaba position would be worth $11,900 basically. And so we would be down $100 on that position. But we would easily be able to just sell our position at a $100 loss in this case, because remember, when we opened up this put credit spread, we received a total credit of $220. And so if we're incurring a loss of $100 because our put credit spread expired at the money, with the share price being below the 120 strike but then above the 115 strike, we would incur a loss of $100, but that would be covered by the total credit that we received initially when we opened up the put credit spread. Now let's say, for instance, in the second scenario, that our put credit spread expires entirely in the money. So that would mean that our share price is lower than $115. It's lower than the short put and it's lower than the long put, right? Well, in that case, when the share price is, say, at $110 per share, we would be forced to buy 100 shares of Alibaba at $120 per share. So that would give us our $12,000 position. But as soon as we had that position and it was trading at $110 per share, meaning our $12,000 position is worth $11,000, we would have the right to sell our position at $11,500 because this is the put option that we went long on. So this would effectively mean that the max loss that our position could incur would be the difference between the strike prices of our short put and our long put. So it'd be 120 minus 115, that's $5 times 100 is $500. So the max loss that our position could have would be $500. But remember, when we opened up the put credit spread, we received a total credit of $215. And so the max loss was actually $500 minus the total credit we received, which is the max loss down here of $285. But there is actually a circumstance where if the share price at expiration date drops below our short put after hours, in some circumstances, it's possible that our long put might expire worthless before the trading day is over, so before 4 p.m. Eastern time. And in this case, if after 4 p.m. Eastern time and after hours, the share price dropped below 120, that would mean that we would be forced to buy 100 shares of Alibaba at $120 per share, but we wouldn't have the right anymore to sell our shares for $115 per share. And this particular situation can happen in an example like if on March 18th at 4 p.m., the share price of Alibaba is trading at $121. And so this would mean that at 4 p.m. on March 18th, our put credit spread expired out of the money, right? But if at 5 p.m. or 6 p.m., the share price of the underlying drops below 120, so let's say it drops to $110 per share, then at that point, the person who owns the put contract that we sold, the person who owns the $120 put, they have the right to sell their Alibaba shares at $120 to us, and we would have to buy it from them. But sometimes, in this case, Robinhood doesn't actually notify the owner of the put credit spread that they're being assigned on these shares until it's too late. So they might notify the owner of this put credit spread that they're being assigned shares of Alibaba at like midnight on the same day. But at that point, the long put would completely expire worthless because we didn't use it to cover our short put position. And so in that scenario, we would just be assigned $12,000 worth of a position in Alibaba, but we wouldn't have the right anymore to sell it at $11,500. And so the next trading day, when Robinhood opens up trading again, Robinhood would immediately liquidate our position in order to cover their own risk. And because of that, whatever the share price is when Robinhood sells this position, that would be the difference between what they sell it at and what we bought it at, which is $12,000. That would be how much money we would owe Robinhood. So we would become in debt to Robinhood to the amount that is the share price that we bought Alibaba at, which is $120, to whatever the share price is when they sell it the next trading day. So if, for instance, we bought 100 shares of Alibaba at $120 per share because we were assigned on the trading day at expiration, and then the next trading day, we no longer have the right to sell them at $115, and let's say Alibaba is trading at $110 per share and Robinhood sells it at $110 per share, that would mean that we incur a loss of $1,000, even though we only collected a credit of $212. And so we would be in debt to Robinhood at about negative $800 the next trading day, just because the share price of the underlying asset moved in an unfavorable direction after hours, and we weren't notified of that before we had an opportunity to exercise our long put in order to cover our risk. So this is the main problem with trading spreads. There have been multiple stories in the past of people who traded put credit spreads and ended up in this scenario. And the best way to avoid this from happening is just for someone who owns a put credit spread to close their short put, or really any spread. The best way for them to avoid this happening to them is just for them to close their short option before the trading day ends on expiration date. That way, even if something happens to the share price of the underlying asset after hours, it wouldn't affect the person who owned the put credit spread because they already liquidated their position before the trading day ended. So this is just a quick heads up just to anybody who trades options to stay aware of this so that they don't end up in debt to Robinhood or in the same position as other options traders in the past who end up in debt to Robinhood because of a situation like this. Like, comment, subscribe, all that good stuff, and I'll see everyone in the next one.